I didn't think a guy working in HR could get involved in something like this until, I started talking to a network of people about it. And that's kind of where that education came from. And the confidence came from of like, oh, wait, yeah, this isn't rocket science necessarily. It takes some capital, sure. But, being an active real estate investor, buying a flip or something takes capital too. So it wasn't a lot different. We're just spending our money differently. And it afforded me the ability to have more time. I didn't have to go work on a rental all the time or get calls from tenants or whatever
Yeah.
the case may be. But the
Yeah.
left field, right field comes from that area. And then, of course, we say those that are diversified on both sides, then they're in center field, is what we call that as well.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter.
I have Chad Ackerman with me on Left Field Investors. So I got to interview Chad at the, it used to be called the IIREC,
Yep.
but this year we were back to back with the Best Ever Conference. And you were on my panel of really focusing on what it means to be successful in passive investing.
Yes.
And I so enjoyed the conversation with Chad that I felt like I need to invite him to my podcast for us being able to share with you guys beyond the Best Ever Conference platform. So Chad, so great to have you here.
Thank you.
I appreciate the left field approach. And so I'm going to go to the website for a minute.
Awesome.
I'm going to share it for those of you who are watching this on YouTube, Roku TV, Apple TV, and Amazon TV. You can see here that we've got Left Field Investors. That is their website. And I want to talk a little bit about your guys' philosophy,
Sure.
sort of your mission. I think it's important. I can't say this enough. When you invest with passively through a syndication, through a fund, through any version where you have an expert that's really going to be running the investment, who they are and their history is more important. I said more important than the actual investment itself. A good investment run by a good quality syndicator will be fantastic. A mediocre investment run by a good quality syndicator will still be beautiful. But a good investment with an incompetent or newer, uneducated, not able to manage, whatever it is, even a good investment, a stellar investment, can go down the drain based on the syndicator's capacity to make it whole and make it right.
Absolutely.
So very important, I can't say it loudly enough, that your syndicator, the one that is your sponsor, the one that is running the team, is truly your biggest and most important asset in the whole investment.
Yeah, the way we put it, and we aren't the ones that coined it by any means, but it's you're betting on the jockey, you're not betting on the horse. So pay attention to the jockey. So you said it very well.
Yeah. Chad, thank you. Thank you for summarizing that beautifully, because I can't, a lot of us want to focus on the asset, and a lot of my clients want to focus on the asset. They want to focus on, oh, is this a good asset? What do you think about ATMs right now? What do you think about multifamily right now? I'm like, okay, those are great questions. And let's never overlook the syndicator.
Yeah, no, very good. All
right. We are a community of like-minded passive investors who challenge conventional wisdom with non-traditional investment alternatives. I'm going to ask you about that one. Passionate about learning, sharing resources, and collaborating with others who share our left field mindset. Hugely important, in my opinion. We seek to reduce tax burdens and unpredictable market swings by reallocating investment dollars from right field to left field. Very clever. We purchase real estate that produces reliable cash flow and provide the opportunity for building equity, and we value networking with investors and sponsors we know, like, and trust. You just so speak my language, Chad. I mean, I've been a passive investor since 2012, around 2009, 10, 11, 12 is when I sold everything that was active, because it was very active at the time. Sold everything that was active, gave birth in 2009, really wanted to be passive in 2009, both because the market was absolute shit, but also because Also because had a
Yeah.
kid.
Yeah. There's your why
I had a
right
kid,
there.
right? Right. So that was my why.
Hmm.
That was my
Hmm.
why. The kid is my
Exactly.
why. It's
E-
still my why.
Exactly.
Um, so that's when I really became 100% passive for a while, and then I was active and passive, but I'm still mostly passive and less active. Um, at that point, it became really clear. Like some people have heard this. I invested in a multi-unit in Arlington, Texas. I was one of a couple different, one of several limited partners, and within a year and a half, I got the phone call back saying, "Guess what? Not only is this project not going to work, you're going to lose all your money."
Yay.
Yay! Oh, how exciting!
Uh,
So from that learning lesson came a lot of, well, how do I do due diligence? What do I expect from my sponsor? What do I expect from the expertise? What kind of team am I looking for? There's a whole series of questions I now have, literally a page long. I know everybody loves it. I have a
right.
page long with the
Right.
questions, but I have a page long. And the things that you hit on, the things that you talk about here, right? When you talk about passion about learning and sharing resources and collaboration, right? When you talk about a network we value, we sponsors we know, like, and trust, those become central to really understanding the
Yeah.
sponsor, right? And yes, we want to reduce our tax burden. And yes, we want to talk about market swings. Let's talk about that. But first, let's talk about sharing resources, collaboration, and being a sponsor that people can know, like, and trust. And why should
Yeah.
they?
No, I think that's the core element of what we developed with Left Field in the community that we built. We built it selfishly to educate ourselves more because we couldn't talk to our neighbors about investing passively. We didn't couldn't talk to a lot of family members about syndications. They, thought we were nuts to hand our money over to some operator that, we didn't really know that well. So our development of Left Field was really centered around education and networking so that you could make a better educated choice of what you went into. And we say start with that operator, get to know, like, and trust them first, then study the market that they're talking about, then worry about the deal. The deal is important, but you need to go through the pecking order in our mind, is what we tend to coach and so forth. Focus on those things. And that's, we built the site to be able to network. We built some tools that relate, that we have a list of questions as well that we have as one of our tools to give out, because, a lot of people that are new to it don't know how to vet an operator. And that's the most important step right out of the gate, is making sure you're comfortable with that operator, that they're answering your questions, that, we always say, if they don't respond well to your questions up front before you give them money, they're probably not going to respond at all after you give them your money. So the more you can vet them up front, the better, the more comfortable you're going to be with the whole experience.
So when you say the website, so you're talking about like the cheat sheet?
That's an element. We have a membership section on our website, and the tools that we have are in the membership section. So
Okay,
yeah.
nice. That's great. So tell us a little bit about the
Mhm.
membership then. Hey, the good tools are behind the membership wall.
That's right.
Tell me
That's
about
right.
membership.
So it is. That's where, like, our core assets are for the community. We have a list of operators that we've worked with. They aren't vetted necessarily, but a lot of what the newer investors are looking for are just a list of operators. You can't go
Mhm.
Google syndication operator and find a lot of people. So we've tried to
Right.
gather a list of people that we've talked to. We've invested with several of them. There's several that we've just liked and haven't invested yet, just to give you a start. So there's 50 plus operators on that list to give you in various asset classes, to give you a start. And then the next tool is a list of questions to ask to vet them, so that you can go through that
Mhm.
process. You don't have to ask all of them, but it gets you a start again to really communicating with that person. Then we built a tool to analyze a deal, that once you've
Mhm.
found an operator, talk to them, you like them, they give you a deal and you want to analyze it. We built a tool that you can dump in parameters from their PPM, and it'll tell you if it's in range of what we feel comfortable or not. And if not, doesn't mean don't invest with them. It just, that's another question to ask and get to know that
Mhm.
sponsor a little bit more, if you will. And then the biggest asset we have behind that, the membership wall, is our forum. That's where all the communication really takes place amongst community members, to allow them to talk
Mhm.
about deals, talk about sponsors, the economy, what they're eating for lunch that day if they want, whatever the case may be.
Right. Right. And it is, I mean, it's, I recently had I have a list of syndicators I have vetted,
Gotcha.
right? And then if I haven't vetted them, I say I haven't
Yeah,
vetted
yeah.
them, right? But I have a list of suggested syndicators because I vetted them, because clients have invested with them, or I've interviewed them and I've talked to them and I've been able to develop the relationship with
Yeah.
them. Um, and
Good.
so therefore they're on that list, and I like their business model and I like where they're
Mhm,
coming from and
mhm.
blah blah blah. And that I had one recently that stopped
Mm.
performing. And I was like, oh
Right,
crap.
exactly, exactly. Yep.
Oh my gosh. Like I wasn't anticipating that
Yeah,
one at
right.
all. Like they were known in the
Mm.
community. They had been involved in the community for a long period of time. I had three different clients who've invested with
Mhm,
them over
mhm.
time. And then all of a sudden here comes the email saying, guess what? We're having
Yeah, yeah.
problems.
Well, and I mean,
Right?
I think that's a state of the economy we're in right now as well, right? That
Sure.
3, 4 years ago, everybody was being successful. Everybody looked like a rock star. Now we're getting to this point where we're really starting to see who shines, who doesn't. So we're seeing some of that as well, where people that everybody thought highly of, we really thought they were on the right trajectory. All of a sudden, the blemishes are starting to show. And to us, that's exactly why we think having a community to rely on is so important, because then it's just not you looking for this information. You're able to hear it from a lot of other people. And we sit in a little bit different seat from what you do, because we tell the community we aren't vetting anything. We kind of play a middleman role of, we have a
Mm-hmm.
bunch of
Mm-hmm.
community members of like-minded individuals that want to network and get educated and have capital to invest, and we have operators that come to us because they have heard about our community and they want to talk to them, pitch a deal, whatever the case is. And we play a middle seat that we say, well, we aren't saying you should or shouldn't get in this. We aren't raising capital.
Right.
We just want to introduce both sides. And you guys vet them yourself and decide if you want to work with this operator or not. But we'll at least give you the diversity of a lot of different operators to meet, and then you can make your own decisions.
And the advantage is that, well, there's so many pieces to
Hmm,
that.
hmm.
One of the pieces of that is that everybody's portfolio is different,
Yes.
right? So when I talk to a person and they're like, oh, well, here's your list of suggested syndicators, I'm like, yeah, but these are the three or four that are right for
Yeah.
your
Yeah.
portfolio for the next step that you're looking for. Because I'm actively engaged in being their financial
Yeah.
advisor or financial
Yeah.
planner. So I'm actually engaged in that process with them. So I will highlight and recommend specific
Hmm.
things that are for them, or that I feel like is appropriate for them. But then I make them walk through the vetting
Yeah.
process, even if I've done it
Yeah.
before. I make them walk through the vetting process again, because ultimately it's their
Their
money
money.
and their
Hmm.
decision. It's their responsibility for them to be able to feel confident in the portfolio that we've
Yeah.
created, that they made the right choice. They know why they made that choice. It's integrated inside of their thinking, inside of their system, and they decided
Yeah.
yes. They decided with an informed yes, right?
Exactly.
And that's the power you're
Yeah.
talking about giving them when you say, I give you a series of questions, and we give you a program to run all the
Yep.
numbers through. There's your informed
Exactly.
yes. We're asking you to make the yes, but here's the reason why it's a yes.
Exactly. Nope. That's exactly. And the founders, there's 5 of us founders with Left Field. We didn't want to take on that burden of being the financial advisor, which is why we play that middleman role instead. And
Yeah.
it's very upfront that we have 1,300 members in our community, and we tell them, this is all your responsibility, but we feel we're obligated to bring you diversity. So we're going to bring you operators of different asset classes. We're going to bring you
Mm-hmm.
operators in different geographies, so that you will have a laundry list of operators to pick from and see what fits your portfolio, your needs, what your goals are, and
Yeah.
those kind of things. But to your point, it's back to them to decide what they're going to pull the trigger on. So yeah, it's very good.
Yeah, and it is an informed
It is.
decision,
Exactly.
right? The power of choice and an informed decision, and the power of
Mhm.
diversification. So one of the powers that you guys actually do bring is the access to diversification. I'm a great believer of, if you're going to be wholly passive, right? You want 10%, or start dividing your portfolio or your investable income. Your net worth versus your investable
Yep.
income aren't necessarily the
Yep.
same thing, right? So you want to take your investable income, you want to start dividing that into 10%, or silos of 3 or both, right? So I might, like for me, I have a silo in the middle of my hard money and syndication investments I invest in, and I try to have no more than a third of my investable, sorry, I have a third of my investable capital in theory in that
Yep.
silo, and I try to have no more than a tenth in
Each of
any
those.
one
Mm-hmm.
particular, right, investment unto
Mm-hmm.
itself. Right? And even inside of that investment, inside that 10%, I might go, so if you take a third and then you take 10%, that means I can have 3 to 4 inside of that
Yep.
one third
Yep.
bracket. Right? Or if I want, I could literally have 10 inside that one third bracket if I want to have greater
Yeah.
diversification.
Yeah.
Right?
Absolutely.
So up to me, up to my risk
Yep.
tolerance.
Yep.
Right? Those are the parameters I suggest to my clients. And I follow inside of my own portfolio. So then I got to start going, okay, well, what's the diversification I'm looking for? Well, I don't know anything about, I know some about mobile home parks, but I don't want to run a mobile
All
home
right.
park. I don't want to be engaged in having to learn how to run a
Yeah.
mobile home park. That's a learning curve I don't want to be involved in. I understand multi-unit, so I have my one third over here in my residential because that's my original love and my deepest knowledge is direct ownership in some version of
Yeah.
residential,
Yeah.
right? So I want to diversify out of residential and out of Indianapolis. And I want to diversify into, right?
Right.
So talk about the diversification.
Yeah, so we preach like 3 elements of diversification in the left field. You don't hear us talk a lot
Okay.
about the right field, just it's not our shtick, if you will. So, but we preach getting diversity in the operators that you deal with, getting diversity in the asset classes that you're in, and getting diversity in the geography. Geography being don't buy everything in Florida and then a hurricane wipes out your entire portfolio is the idea. But we feel if you can get to those 3 realms, then it helps protect you in what economy dip, is going to affect what asset classes at what times, and what's a lead example versus a follow example that's going to affect you that you need to think through. Are you worried about cash flow versus equity bumps? How are you spreading around that, and what phase aligns to your goals and so forth? So we don't give specifics like silos and percentages necessarily. It's more, we know if you get to these different aspects of different operators, different asset classes, different geography, then you run a better chance of being successful through any market, hopefully, unless we have a global pandemic and who knows what happens, but we're still figuring that out. How often does that happen, right?
We're still, yes, it doesn't happen very often, thank goodness.
Right.
Spanish influenza was the last one
Right.
that we could really
Yes.
claim, as far
I
as I
missed that
know.
one. I missed that
Uh,
one. So,
yeah, I missed that one too. I wasn't around for that one, so
uh,
but
yep.
but yeah, so you never know what's going to come out. But yes, diversification is
Mhm.
huge,
It's a very
right?
big deal.
The tornadoes in the lower Midwest, right? And all of a sudden, that's or the fires up in Malibu. I mean,
Yeah,
just pick
exactly.
your national
Everybody has their
disaster.
thing, right?
Everybody
Yeah.
has their
I
thing.
mean,
So, and I like the diversification again, not just because of natural disasters, but like I said, your syndicator can take something that's good and make it fall on its
exactly.
head,
Yes.
right? So, and so I like, oh, but I have this, like I had a client the other day, he's like, oh, but I really want to do another with X, Y, and Z. And I said,
Yeah.
no,
Yeah. Yeah.
no,
It
no, you've hit your quota. I don't care how good you think
exactly.
they are. And I don't care if you feel like they're offering you 14%.
No, I
No,
mean,
you
it's a
can't.
risk, right? To keep putting
It's a
eggs in
risk.
the basket.
I just,
So
I have just,
it the
I obviously my client's going to do what my client wants to do,
agreed.
but my answer
Yeah.
was,
It's not your
I
recommendation.
hear you, but my suggestion is
Yeah.
no.
My personal approach, I'm trying to meet and invest with as many operators as I can that I know, like, and trust
Hmm.
to get that broad spectrum that after several years, then I'll probably go big with fewer and
Okay.
working my way down to a much more passive relationship with them. But I'm always going to need to research because there's going to be an operator that I love that just decides they're done and they don't want to, do it anymore. They're going to sell off and retire themselves. What am I going to do then? Well, I've got to keep kind of, to take our baseball analogy, I got to keep some bench strength available to plug in
Yeah.
if a starter falls out of the game. So I will always be, we call it an active passive investor, because you've always got to
Right.
be digging into deals, understanding operators to some degree. Do you have to go through the entire PPM every time with an operator that you know pretty well? No. Should you go through it all? Probably. You never know. You want to be sure you're covered, but I want to get to that point where I feel pretty comfortable with operators after some time that will limit my list that I'm really researching. And then maybe I'm keeping 3 or 4 in the on deck circle there to make sure I'm comfortable with a fill in if I need it.
Yeah, sure. Let's talk about active passive investing.
Mhm.
I love your description about bench strength
Yes.
because I often, well, I have run into and I continue to run into people who are like, oh, I'm an older investor. I've been doing this for a while, and now I've got 30% with this one
Mhm.
person with this one. I got another 30% with this one, and I've got a 30% that I'm wanting to like diversify more because if I just have three people I'm placed with,
Yeah.
then I'm really
Right.
exposed,
Right.
right? So the bench strength is a perfect
Mhm.
example. So talk about being an active investor and what that lifestyle looks like, because I think people don't understand. If I'm passive,
Right.
aren't I?
Right.
No, no.
No, there's activity you should do to be an educated investor. You still should stay up to speed with what's going on in the economy, stay up to speed with what your operators are really how they're functioning in their deals because they pivot their strategies. They'll adjust to economic markets that may need their attention somewhere else. A lot of times they'll switch asset classes along the way. And are you prepared for that? Do you trust them? Or one of our mottos is we don't want to be the guinea pig for any operator. So if they pivot to something different, again, it doesn't mean no, we aren't going to go. Maybe they partnered with somebody that is uh, has been doing that asset class for years that you feel a little more faith in that you could trust and go, or it's, I'm going to watch you for a year, but that's that active side. I'm going to watch you. I want to get your communications. I want to see how you break down deals. I want to follow what you're doing in current deals to decide if I want to get into future deals with you is what we recommend a lot too. So there's activity to do. You don't unfortunately there is mailbox money and it's great, but you've got to earn that mailbox money by doing your homework and making sure that the people that you're investing with are trustworthy and you can give them your money and expect to get returns back. So it never is truly passive, really.
It's never truly
Mhm.
passive. Yeah, I tried to describe to people like it can be as little as 3 to 5 hours a
Sure.
week.
Yep. Yep.
Sure, you can pretty much track a
Mhm.
relatively complex portfolio in 3 to 5 hours
Yeah.
a week. If you're actually doing 3 to 5 hours a
Hmm.
week, I don't always do 3 to 5 hours a week. Sometimes it's 6 hours in week two. You know,
Absolutely.
I mean, I just saying like because we live life,
Yeah.
right?
Yeah.
So, you know, but you do want to anticipate being
Yes.
engaged because if you're not tracking it, it starts to becoming non-performing. What I've noticed is you end up with a whole bunch. You end up with all the performers, right? And they
Yep.
pay, and then they pay
Yep.
out, right? And then after a while, and this often is with the cycle. I've noticed it's also in the cycle when people stop performing, you end up with a portfolio that can be heavy in non-performers, and you're not conscious of it until it gets too
Yeah.
big,
Absolutely.
until the weight of the non-performers starts to really weigh you down, and you go, "Hey, wait a
How did I
minute,
get
how
here?
come I'm only got how did I get here?" And then it's exactly then it's a how did I get
Hmm.
here?
Hmm.
Right? And then sometimes it's a little late to try to be engaging in the game of like, oh, well, now they're not performing. And,
Exactly.
you
Yeah.
know,
So
'cause-
it's you got to be
so
engaged. That was a good word for it. Because there's always stuff you have to watch. Nobody else is going to watch out for it the way that you will. So you need to
yes.
expect to be engaged in it for sure.
So you talked earlier about this right field versus left
Hmm.
field. That's clearly true, your guys' particular
Right.
wording. Tell me what that means and why you bothered to really
Sure.
define that.
So left field investors came about because anytime we seem to talk about syndication investing, limited partner investing as passively to our financial advisors that were stock providing, 401k backer kind of mutual fund financial advisors, they
Mhm.
always
Yeah.
consider that other area left field kind of stuff. Oh, you're out in left field with the wanting to do that.
Oh,
Yes.
yeah.
So
Oh, yeah.
that's where our name
Got
came
it.
from. That we love
Right.
the name. Sadly, none of the 5 of us are really baseball fans, so it's lost the whole analogy is lost on us to a degree, but we love the name because of where it came from.
Right.
Right field to us is all that traditional, what we were taught growing up.
Yeah.
Go get a job, put your money in a 401k, maybe get a mutual fund, maybe set up a Roth. all of that is the right field kind of stuff to us. That, if that's where you want to go, that's fine. We just want to educate more people that there's something else out there, that there's this left field side of things that doesn't get taught. That, I thought it was for the ultra wealthy or something. I didn't think a guy working in HR could get involved in something like this until, I started talking to a network of people about it. And that's kind of where that education came from. And the confidence came from of like, oh, wait, yeah, this isn't rocket science necessarily. It takes some capital, sure, but being an active real estate investor, buying a flip or something takes capital too. So it wasn't a lot different.
Mhm.
We're just spending our money differently, and it afforded me the ability to have more time. I didn't have to go work on a rental all the time or get calls from tenants or whatever
Yeah.
the case may be. But the
Yeah.
left field, right field comes from that area. And then, of course, we say those that are diversified on both sides, then they're in center field, is what we call that as well.
Oh, yes. Yes. I do have stocks, and I do
There you
have
go.
real estate, and I do have the syndicator notes in the
Yep.
middle.
Yep.
Um, I am overweighted in stocks right now.
Mm-hmm.
I'll just
Mm-hmm.
confess, I'm overweight in stocks. I'm more than a
See,
third.
I'm I'm
It's not a
uh,
good time to be more than a third in
I'm one
stocks.
of those, maybe crazy, I don't know, maybe smart when it's all said and done. Once I got into this space, I ended up liquidating all my stocks, my 401k and everything, and I moved it all over. And I haven't looked back. I've been happy with it since. So I say, ask me in another 2 or 3 years, let it all go full cycle once, and then I'll tell you if it really worked or not. But so far, I'm very
Yeah.
happy with that decision.
No, I have at times been in my investment time period been 100% in real
Hmm.
estate, and
Hmm.
then I had a family member who passed away that sent me
Gotcha.
stocks as part of
Gotcha.
the.
Yeah.
I'm like, oh, now I got
You
stocks.
got that. They're
Okay, I
back. They're
remember.
back. Hey.
They're back. They're back again.
Oh, that's great.
Ugh, what do I do with
Yeah, that's
stocks?
great.
Because I'm not an expert in stocks. I don't.
Mhm.
Let's talk about the
Yeah.
diversification or the differences between the traditionals, the
Yep.
stocks and the
Yep.
bonds. To me, is traditionals, and the alternatives. Right, so right field, left field. The alternatives, which would be ownership of real estate, syndications, Bitcoin, if you want to
Yeah.
include that. Although to me, that's even left
Right.
field of
Yeah.
left
Yeah.
field. That's, that's because I'm too old, right? But yeah, I feel like I don't have, stocks aren't the
Yeah.
same.
No, and
You tell
like
me,
I
what's your
what
experience?
I think was the most exciting thing about coming over to this side, comparing the stock
Tell me.
world to the real estate world, the passive real estate world. I can
Right.
call on the phone and talk to the CEO or the operator, the general partner that's driving the whole project to understand how their strategies are working or not working, or have conversation before I ever pull the trigger. Even after I pull the trigger, I can go walk properties with a lot of those and understand, show me your vision of this and this kind of thing. I can't do that with Apple. I can't go to their headquarters and say, I'd like, 30 minutes with the CEO. You don't get that kind of flexibility. So it's almost more passive to be in the stock market, because you're putting it in there and it's gone, and you just ride the wave. And the wave is what really changed my mind. Watching my 401k go up, down, up, down, up, down through so many years, that I'm like, well, this is fine. When I
Yeah.
was younger, I liked it because I knew when it was down, I'm buying it cheaper and this is going to rebound and it's going to be better. As I grew older, then I'm like, okay, I'm watching these cycles. What are the odds I want that money when it's down? And how long will I have to
Right.
wait for it to go back up to be happy with it? That it was starting to resonate with me that I don't think it's bad to play in center field and have diversity with some in stock, some in the real estate side of things. I think that's probably smart. I just was at a position with the goals that I'd set for myself, that getting it all out of the stock market and into real estate made sense at the time. And so that's why I pulled the
I,
trigger
I,
that I
yeah,
did.
I
Mhm.
understand. So it's like there was a time when I went from being primarily active to being almost to 100%
Yeah.
passive
Yeah.
because it made
Yes.
sense. Right. And at that time, it was 100% passive, all in real estate
Hmm.
holdings of some kind.
Hmm.
Right. Um, so I guess I had a question. I think I
Oh,
lost it. Let me go back here. Let me see if I can find
mm,
it again. So you really try to find a way to you say you talk about reduce tax per burden and manage the swings, but it sounds like in that sort of the behind the wall that we talked about, the members wall, is that series of calculate the calculator you
Mhm,
put it
mhm.
through. Tell me, you guys have obviously created a series of definitions, expectations, or standards. Probably standards is the right word. A series of standards as to what is considered a solid, safe investment or safe
Yeah,
enough. I mean, real estate isn't going to be 100% safe all the time. Stocks are
right,
clearly not 100% safe all the
right.
time, right? So, what is it that went into that, and what are some of the parameters and standards that you guys look
Yep.
for?
So we work in ranges. Like it's not a scripted prescriptive thing. So we work in ranges. A lot of it was just dialogue amongst us founders, and like what are you comfortable with? What's our high low? And okay, let's fudge it out maybe a little bit wider just to allow some more room to feel like that's a comfortable metric in the PPM to be okay with. A lot of it was off of that. Honestly, Brian Burke's book, The Hands Off Investor, that helped us out a lot. He's got a
Mm-hmm.
lot of great
Okay.
advice in there too. That kind of fed into a sixth voice to have at the table, if you will. That okay, we aren't totally off on our own in left field ourselves because Brian felt like, hey, some of these ranges are that we've come up with are about in his ranges too. And it's a fluid thing, right? We have to go back and revisit that every year or
Mm-hmm.
so just to say, does this parameter in this economy still make sense to have a range from X to Y based on current market conditions? So it's a living document in our mind of something to go back and view for current state, just to be topical, be up to speed. Again, to help educate that investor before they pull the trigger of like, is this way off base or is it within a range that seems like it matches what we're seeing in other deals right now kind of thing.
Because that is a question I get a
Yeah,
lot.
yeah,
I get it when I'm on a panel. I get it when I'm talking to my clients. They're like, "Oh, well, what do you look for in a PPM? What feels like is
right,
right? What feels like is wrong? And you have to start breaking it down into these sort of like, gee, if they're looking at a rent increase and they want to have a rent increase that was more than 3%, unless they're doing a strong value add, that's a red flag
exactly.
for me,
Well, and are they doing
right?
it
You're
year
not going to
one and
increase.
they're trying to do all this renovation?
But
Well, is that really
exactly,
going to
they're
happen?
doing it.
Yeah, yeah,
Yeah, year one, they're like, oh, we're going to increase rents 10%. And by the way, taking 2 years to renovate the
yeah,
building.
yeah,
It's like, no, you're
yeah,
not.
exactly,
You're not going to get all rents up by 10% in the first year and be able to renovate the building over 2 years.
exactly,
Right? So those are
exactly.
like, that's one red flag. In other words, you exit cap
Yeah,
rate,
yeah.
right? That would be another parameter. I think Brian does a good job of breaking
He
those
does.
parameters
Yeah.
down.
No, and what I have seen having started left field and been in this for a little over 3 years now with left field, my own education, my parameters have changed quite a bit. When I first got into this in
Mhm.
2018, like the shiny object I liked was the multiplier is a 2 and cash flow is 8%. That sounds good. I think I'll get in this deal. Well, I didn't look at all these other metrics that I should have been. So my
Okay.
education and the environment has changed the parameters I really focus on to where debt is a huge deal to look at now. That I didn't pay that close attention to debt the first couple years that I was doing this because it's just kind of standard. We saw the same thing on everything and just felt like that was okay. And then all of a sudden rates go through the roof and like, okay, well now should I understand variable rate debt better and caps or no caps and what's that going to do? How well did you play conservative in your estimating versus what the market's really doing right now? So it is amazing to me to look back at how foolish I was to get in the first few deals I got into because I just saw 2x and 14% IRR or
Yeah.
something, thought that was great. So that's been one of the benefits of having been involved in this is just becoming a better investor because you're understanding more of that PPM and what to look for in different markets and so forth.
Yeah, and I think you bring up the point beautifully, which is a younger investor is like, what am I going to get out of it?
Exactly.
Whereas an older investor is a little like, oh, how are they actually managing the
Yeah.
deal?
Yeah.
Right? Are they over promising? Are they under promising? Is a simple terminology, but it is things like the rent increases. It is things like how are they managing their capital
Yeah.
stack, right? How leveraged
Yep.
are they, right? Do they have their own money into the deal? It's things like, gee, are they have a reasonable expectation as to how long the rehab is going to
Mhm,
take,
mhm.
right? I personally like to see not the exact line item of their construction budget because I can't usually
Yeah,
get that, but I do spend time to look at their construction budget and go, is that reasonable? They really think they're going to be able to rehab every unit to the if they want a $200 increase, then they can do a minimal rehab. If they want a $400,
yeah,
$500 increase, then I need to see a large
it
rehab
does.
budget on
Mhm.
every that has space on every
Well,
unit, right? 15,000
yeah,
or
and
more.
this speaks to why you're an active passive investor still. That you need to understand those, be able to find that information in these PPMs to make that educated decision. You can't just relax on the 2x and the 14 IRR. That's not, you're going to get burned on something like that. So this
Oh
all
yeah,
speaks to that same logic of you've got to be engaged. You got to understand what they're really trying to do. Does it make sense? You don't have to be a construction expert and know, oh, you're paying way too much for lumber in this. It's, more, does this make sense from a timeline to really get this done? And are you really investing enough money into it, to your point, to get the rent increases that you think you will? So,
the other one
mhm.
increases. And some of it is common sense, but it is common sense against a background of like, okay, I've seen so many
Yeah,
of these, right? I mean, it's this part of why people go to left
yeah,
field,
yeah,
right? Is that they go to, hey, you guys aren't going to put anything in the 50 that you think is truly like
right.
outrageous,
Exactly.
right? Like outrageously off the reservation, if you
There
want
you
to
go.
call it that. Like, no, there needs to be some version of reasonableness. There needs to be some version of history. There needs to be, you know.
Definitely.
So you tell me, what are your parameters for people even getting
On
on
it,
that for
yeah,
operators getting on that?
that's a good question because we struggle with that.
Because you need diversification. You need to have
Exactly.
broad parameters because you can't make it so narrow that it's a whole bunch of
Exactly.
multifamily flippers that are done in rehab at year 3 and sell at year
Yep,
5,
yep.
right?
And this strategy has changed for us over the last couple years because we were very tight with it first and we thought, well, we're only going to do our preferred partners. And our preferred partners are people
Hmm.
that a lot of the community members have invested with. They've been doing it for years.
Hmm.
They're kind of that know, like, and trust. They're at that know, like, and trust level for us.
Right.
So we
Yep.
we started out using those, but then we knew, to your point, we needed to give our group more diversity. And so
Yeah.
we relaxed that to say, well, I mean, it's kind of to a point of if something just doesn't register with the operator, then we're going to tell them, there's different ways to meet our community if you're an operator. You can come just do a lunch and learn and not pitch a deal to us. That's part of our education.
Hmm.
Teach them something about your asset class or
Hmm.
your model of business or whatever the case is, but not pitching a deal. Let's just get to know you a little bit more. So we've got some of
Right.
that cadence built into how we can get to know an operator that we don't know at all. But at the same time, we don't want to chase off the young operator or new operator to us. They may be the next big thing. We don't know. But we like to get that feedback from the community as well. Hey, has anybody invested with this? And
Hmm.
we've got over 400 people in our membership section that, in general speaking, if nobody out of the 400 have heard of this individual, well, it's a pause. It's not
Yeah.
a red flag, blow
It's a
stop,
pause.
but it's a pause of,
It's
hey,
a pause.
let's give you a year and watch what you do. Put us on like we're an investor with you. Send us the communication on current deals. Let's watch it, and then we'll see if we're in a different spot a year from now. But because we sit in a seat that we aren't vetting operators and we're telling our members to vet, it gives us a little more flexibility to let the floodgates open a little further than probably you did, where you
Hmm.
want to be sure you
Right.
feel
Oh,
good about
very.
it, right? You have very strong
Yeah.
parameters. So ours are more,
Yeah.
we always kind of kick it out to the community. Have you ever, anybody ever heard it? We actually have several members in our community that are on kind of an operating checkpoint kind of committee that we ask them to go talk to these operators too. And hey, what do you think? Give us your feedback. These are
Mhm.
guys that are full-time investors that do a lot of vetting of operators. We like to get their take because we're five
Yeah.
guys. We kind of know what we're doing, but if we can have 10 guys' opinions, gals, whatever, all the better.
Right.
So
Better.
we've tried to
Yep.
set that committee up. We're actually developing a new tool for insider membership that's going to be kind of a Yelp for operators that we can get
Ah.
feedback from our
Oh.
our members
Oh.
on different operators. So
Wow. I
that'll
like
be a
that.
help
Yeah.
for all of it. We want to get that up and running this
It
year.
will
That'll
be.
be a big deal, we think. Yeah.
Nice. No, that will be very, very
Mhm.
helpful.
Mhm.
Be very, very helpful. Yeah, it's I will tell you one more thought and then I'll change the
Go.
topic.
Yeah.
So there was a time when a friend of mine, an associate of mine said, Christina, you spend so much time doing due diligence for your clients. You should start just rating. This is like you should come with a rating system, like a triple
Yeah, there you
A,
go.
double
Yeah.
A,
Yeah.
like you just, and I'm just like, but rating for, but I
Yeah,
get it.
yeah.
I like the concept. It's super fun, but rating for
Yeah.
what? Because the problem is, what is my investor looking
Exactly.
for? Is just as important as to what this sponsor is
Yep.
offering. And yes, there's a whole series of parameters that are consistent, which is, are they capable? Are they competent? Do they know their business model? Whatever the business
Yeah.
model is, are they bringing capital to the table, or do they have large capital behind them so they can manage a
Yeah.
problem if a problem
Yeah.
occurs? So there is sort of a series of like, gee, they kind of have to have these core elements, regardless of their
Strategy and
asset
stuff,
class
right.
or whether they're focused on appreciation or
Mhm.
cash flow.
Mhm.
All right. So that being said, problems. Let's talk about
Mhm.
problems. So we've we've discovered over the years, I've discovered over the years that there are usually problems of some kind in almost every deal, right? Some of those problems end up being big
Yeah.
problems, and some of those problems end up being very solvable. So give us a story about a problem that was a relatively big problem. Obviously, we always have to solve them at some point in
Right.
time, right? There's a conclusion to the problem, period. Always. Tell us an example of what was the problem, how'd you fix it, and what did you learn from it as an
Yeah,
investor?
so I'll speak to us basically developing left field. Um,
Okay.
our problems that we've come into that have been big, a lot of it's just the growth and trying to keep up with the fact that the community grew. Again, we were five guys. Our intent with this when we started was that we were going to have 10 or 15 people locally just meet at a restaurant and have conversation about it. And then the pandemic hit and
Yeah.
we went on Zoom, and that caused us to create left field as it is today. So a lot of it has been
Okay.
growth and just growing out of what we were able to provide and not providing good feedback, a good product for our community members. And this is a generic one, and I apologize for that, but it's what popped into mind for me. And so
Okay.
what we did, a lot of it was we just stemmed off of, let's understand the feedback from our community of what they expect, what are they looking for. We Because we built things the way we did, we built a culture before we ever built a business, because we didn't think we had a bit, we didn't know we had a business. So we've always relied on feedback from our network of people that are like-minded, that, hey, what are you doing that we aren't providing, what would help. And one of the fixes out of all that was we weren't providing crypto background enough. And a lot of the community members, this is before the crash, were really excited about crypto and wanted to learn more. And we had a community member that then we kind of been putting feelers out of, hey, does anybody have knowledge in this space and would be willing to help out? And we had an individual raise his hand, says, I've been doing crypto for 17 years. I love it. I'd love to educate people on it. That we were able to then
Mhm.
pull them in, spin off a subgroup that was crypto focused, and away they
Mhm.
went under the left field moniker, but crypto focused as opposed to, all the traditional asset classes that we deal with in the syndication world. So it was interesting. We love seeing the subgroups pop up because that just means we're networking and educating in areas that people want to learn. And that's our
Mhm.
biggest goal for left field, is to provide that either that area for people to come and talk about it, or us build things to be able to provide to them and help them out. So I don't know. I didn't give you a good one, I don't think, but I can't.
No, you didn't, but that's
It's
okay.
a flash kind of thing to share with you, unfortunately. Knock wood,
That's
thankfully,
okay.
but
That's all right. No, it's just it's just having been a direct operator, I've seen things go wrong in
Mhm.
my own, in my own projects. I say this all the time. Somebody asked Bruce Norris once, who's done over 2,000 deals, and it's like, out of all the deals you've seen, how many have
Yeah.
problems? And he's like, really, every one of them? He's like, yeah. He's like, oh, about 19 out of 20. It's like there's always a thing to
That's fair.
solve, and so I'm just this sort of great believer of like, well, it's as I shared with you before we started the turned
Yeah.
on the
Yeah.
recording, right? Which is, it is your asset class. It's understanding your knowledge. It's understanding your basis and being able to know, well, what is a multifamily and how does that perform versus a storage unit. It's, can I solve a
Yeah,
problem?
yeah.
What's the mindset I need behind failure and risk management
Yep.
so that I stay inside of a solution set and trying to solve things versus feeling like I'm being abused or beaten up by all the problems that are going to
Yeah.
show up, because they do
Yep.
show up.
This is Christina Suter with Real Estate Breakthrough. You can find us on all kinds of platforms. I personally suggest YouTube or Roku TV. Those seem to be people's favorites. See you guys again in 2 weeks.